I think we have already Ornit via Zoom, right? Sorry. Hi, Ornit. Can you hear me? Not sure you can hear us.
Can you hear me? I can hear you.
Okay, perfect. So thank you for joining us. It's my pleasure to announce you Ornit Shinar. She's the Global Head of External Innovation and Venture Investing at Citi Innovation Labs in Israel, right? Based in Israel. So happy to have you here today with us via Zoom. We will start right away because we have a slightly delay due to starting late the conference. But thanks for staying in the lobby and wait for the session. We already discussed and I've seen at the previous presentation that one of the startups that Jam mentioned was backed by Citi VC, so Citi Venture. So it's nice to see that before the session. I would ask you because today and also yesterday we talked about 2022 as a very special year and very hard year till now. And I will ask you about what challenges have you been noticing in this year in the startup space, because you are interacting with lots of startups from the region, not just from Israel.
Sure, and so yeah, we look at startups from all around the globe, and I think there's one thing that is in common to all of them. Everyone's talking about the fact that there is money and money is available, but it's no longer the party it was in 2021. So when you now need to fundraise, everything looks very different. And perhaps most difficult to adapt to for the startups is that if they were used before that to a specific set of requirements and KPIs, if you will, that were expected of them in order to fundraise, this has shifted massively. And investors are looking for different criteria and different types of growth metrics when looking to invest in companies. So the fact that something that looked so static and so obvious has completely changed, I think, is the hardest thing to adapt to, because you need to rethink the way your startup is run in order to be able to raise future funding at this point.
Can you please develop more on the KPIs and what has been updated here? I mean, in 2021, I guess it was more exuberant and maybe investors overlook some, I don't know, maybe red signs or so. But in this year, what is the updated version of KPIs for a startup to get financing?
Sure. So in 2021, you needed to show that you were growing very, very fast. And if the growth wasn't the best, it wasn't necessarily something people spent too much time looking at. So someone sarcastically told me that if you had a heartbeat in 2021, you could raise money for a seed venture, for instance. Low bars, right? You just needed to be a strong team, something that looked like a good idea, and you would get funding at the early stages. And at the later stages, you needed to show that you were growing fast, but whether the quality of that growth was the best or not didn't matter so much. And suddenly in 2022, there's two new criteria that have become, I think, hard-coded into what investors are looking at. First one is people are looking at what runway you'll have. Gone are the days when they're willing to fund something that will have a year's runway. You need to show that you have 2 years of runway. And perhaps most difficult is that this moves along, right? I mean, you raise money and you have 2 years of funding with that money. And then 6 months later, you have a year and a half of funding. You have to show that the next money that you're raising is going to bring you back above that 2-year mark. The second thing is the quality of the growth. So it's not enough to show that you're growing 4x, which is amazing. But if that growth is built on something where you're basically funding it, or where the quality, the revenue that you are left with in the end is minimal, people aren't as impressed anymore as they were in 2021, on the one hand. And on the other hand, if you're growing and growing, but you're not getting closer to profitability, people are very wary of that now. They don't necessarily expect you to be profitable anytime soon, but they want to see that you know how you're getting there and what it is that will bring you to that point.
Yeah, got it. And this change in a matter of months, I guess.
Yeah.
Yeah. Okay. Now, I think that you represent what we call a corporate VC. So I was curious about if a corporate VC during these times, during these downturns, are more reliable source of funding for startups.
That's a great question. And I think if you look at 2021, most of the investments that were done were made by corporate VCs. I'm saying most, I don't mean 51%, right? But a vast amount of money that was flowing in to the startups was from CVCs. I haven't seen the numbers yet for 2022, but the thing that is a constant is we're not measured in the same way, if you will, as a regular VC. So if in a regular VC, they're out to get profitability, full stop. And so at a time like this, they could invest because valuations may be lower. And by the way, we haven't really seen them get lower yet, right? I mean, they're a little lower, but not dramatically. It's mainly that there's a lot more structuring going into the deals. So they're more protective of the venture capitalists versus valuations being so much affected. So if you look at the CVCs now, CVCs typically, we still want to have a reasonable deal, but we may have other factors involved as well. So for instance, we might look at how much revenue it can produce for us in other domains, right? So in what we're producing. And I'll take an example in hardware because it's always the easiest. Let's say I'm a computer manufacturer. Mm-hmm. If the investment itself the revenue from the investment will be 2, 3, 5 million, I don't really care, right? But if it will make my computers sell 10 times more, I'll be making a lot of money from that. So I'd be much more interested. And the same thing goes for every type of CVC. If I can prove that this investment is going to generate a lot of revenue for my entity, I'll invest because it's a good investment for me. And the money I'm investing is a side topic, in a sense, to the main story of the use case it's generating within my organization. That's not to say that I'll invest at any price or I'll invest in a terrible company, but I'll continue to be in the market for my own business. This is the point. And I think in that sense, CVCs will remain. They tend to be sometimes a little more conservative. So I think it'll be interesting to see what happens. And as the market is moving to earlier stage deals, that might also make it a little bit more difficult for some of the CVCs. But I think just like everyone else, we will all be adapting to the current climate and working within that framework.
Yeah, got it.
For us, we haven't slowed down.
Yeah, understand. Okay, so besides extending runway, which is like a buzzword these days for at every conference, startup conference, what else do you recommend to startup founders to navigate the downtrend in a more smoothly way? I don't know, in a better way.
That's a great question, and I agree. The funding part is easy, right? That's where we all are, and it's a magic trick that only works by constantly reducing your burn. So I think, it started out with people considering that the way to work around it is to constantly consider how to keep your best people, it's a good time to make sure that you're only investing and streamlining in what is actually the most strategic part of your product. So I think if in the past you could do all sorts of trial and errors around additional things all around it, and maybe be a little bit less focused, now you have to be laser sharp in what you're doing and know exactly where you're headed. I would say network, build up a lot of relationships, try to make sure that you're ready to go. It's going to be harder. It's not going to be impossible. There is money in the market. This isn't 2008 where money was an issue, or 2001 where trust in startups went down to zero. It's a different situation, right? The situation right now is about proving that what you have is actually valuable. And as long as you can do that, you will be able to fundraise. So I think relationship building with potential investors and clients is critical in time like this.
Yeah, thanks. I understand. Now I want to go to talk more about Citi Innovation Labs, and I don't know, what are the main advantages for a startup to work with Citi Innovation Labs and to enter such programs?
Sure. So Citi is an organization with 220,000 people, something like that. So even for us inside, when we're trying to find the right person that deals with subject matter X, it's difficult, let alone for a startup on the outside. And so the programs that we've set up are programs that are geared at two things. One, helping you navigate and find the right people within the organization so that you can engage with them and try and see if there's a good match. And we're big believers not just in making the match, but getting to a quick answer. If it's no, that's fine. But a quick, painless no is critical, right? So we're not wasting your time spinning your wheels if we're not interested. And if it's a yes, then again, making sure that we understand what this yes means. So we've set up testing sandboxes so that we can quickly evaluate, quickly get to decision making, and assist in the entire negotiation and onboarding process with the startups. So that's one aspect of it. I think the other aspect of it is that we have Citi's shopping list. We know what the company is looking for. We can go hunting for those specific things, and we can help bring the right people together from the startup side as well. And the third thing I would say is that we do a lot of design partnerships. So even if your product is still early, we know how to consider and evaluate what it's going to bring to the table and help you tailor your product in the best way possible so that it actually fits the needs of Citi. And often if it fits our needs, it will fit the needs of vast majority of large banks, I would say.
And if we refer, especially for fintechs, how do you help them scale at a global level? I mean, you have a network of partners, a network of course, banks and branches in every country, I guess. So besides funding, how do you help them scale?
So, and that's a great question. So we're a global bank, right? So if we're looking at your product, it's very unlikely that we will look at onboarding it specifically for, a country somewhere. We will look at it as a global solution for the bank. We may roll it out country by country, but it's very rare that we will onboard a local solution unless there's a very specific need in that country. And so if you're working with a group like ours, very quickly we will start looking at, okay, so can we use it in the US? Can we use it in Europe? How can we take it and bring it to the world on a global scale? The other thing that the labs do is that we often we do warm introductions to our clients. So whether it's large retailers, other financial institutions, banks, insurance companies, PE firms, etc. So we help with all of that. And of course, we also help with introductions to other investors where relevant. And so all of that together creates a macro economic environment, if you will, where the startup is set to success because we're automatically looking at how we take it to a much bigger place than what it currently is doing just by the very nature of the way we are built.
Okay, thanks. And one final question, because we often hear that in Silicon Valley you can get a lot of money. There is like the epicenter of VCs. Maybe in Europe, UK is also considered a good place to go make some connections and try to raise money. But what about the region? What about I don't know, Israel? Can you go to east, at least from Romania, and try to raise money in Israel or other countries around?
So it's a very good question. I think in the end, it depends on what stage you're talking about. So if you look at companies at the very, very early stages, typically there's an expectation that they will raise locally their first money. And it's usually like that because at the very early stages, the investors want to have a hands-on relationship with the startup because it's still ideating, changing courses, pivoting quite substantially in the very early stages. I think as you go forward to later stages, it's much easier to get international money. And I think that if you go then, you'll find that there's a lot more buy-in into it. First of all, certainly if there's a local player that they trust. So an investor will very often get comfortable if there's another investor that they already know in the company. But secondly, because the company already has more direction, there's metrics that can be analyzed, there's more hands-off type of management that can be done. And I think at those points, certainly you can go and fundraise at an international level.
Got it. Thanks. We will have time for one question from the audience if there is someone who wants to address a question to Ornit. Now is the time. I'm guessing there isn't someone around to address the question. So thank you very much, Ornit, for joining us today and for your insights. And I hope to see you at other conferences, other future banking conferences, maybe next time in person here in Romania.
I hope so. Certainly would love to. Thank you for having me.
Yeah, it was our pleasure. Thank you and have a good day.
Thank you.